Hey guys, welcome to the second part of Chapter 9, Financial Instruments in the Fin module. As you recall, we've already been through Part A, which touched on financial instruments. And because this chapter is just so long and complicated, even the CSG itself has had to split this into two parts. So today we're going to be going through Part B, which was around hedge accounting. So I guess first of all, let's touch on what is hedge accounting. So the first part of the relationship is this, the financial instrument, which we've already touched on before. In this example here, we've got a customer who sells goods for 20 million euro and payment is expected in 9 months to a US producer. So, is there a financial instrument here? We've got to think back to the three-party relationship. So, we must have an underlying financial asset, which is the inventory or whatever they are purchasing. There is the underlying financial liability, which is the trade payable or the expectation to pay the amount to the producer. And there is a contract, which is the future payment, which is contracted of 20 million euros. So this would actually fall under this Ifrs and would be a financial instrument. Now, what is hedging? Hedging is the second part of the relationship over here. In practice, it's a very common thing because it helps enable businesses to protect against the unknown in a similar way that insurance payments is a regular expense for business in the case that the unexpected variable that they cannot control, for example a fire or theft, etc., they would be protected in this instance for a cost. Hedging is very much the same thing because there is this unknown in the business, which is we don't know which way the exchange rate is going to go. 20 million euro could be worth a huge amount of money in the future, or it could be worth very little in the future. We don't know, but we want to lock that in now so that there's very little risk. So what they'll do in this example is they'll enter into a forward FX contract, which is a type of hedging instrument to protect against those exchange rate fluctuations. So it's important to consider what are we protecting ourselves against, and in this situation it's exchange rate fluctuations. So what they'll do in practice is they'll lock themselves into a slightly higher exchange rate than what is in today's rate. That's the cost of doing it, but in exchange they get some stability about what they're going to pay in 9 months' time. So that is how hedging works. Hedge accounting is the way we account for hedging instruments. Now, the most important thing about hedging accounting is that it's optional. You don't have to apply hedging accounting. However, hedging accounting under this standard is actually a very preferable method for a lot of businesses because what it does is it actually offsets the gains and losses similar to the way it does in real life that you're recording from this financial instrument. For example, in this instance, we have a payable in our balance sheet of 20 million euro. And if you remember back from our Forex chapter over here, we're going to have to revalue that amount. And any gain or loss on that revaluation is going to go through the P&L. So for $20 million, that could be a huge amount of money. It could be $1 million in profit or loss going through your P&L. However, if you enter into a forward contract, what happens with that forward contract is the value of that actually inversely increases or decreases. So for example, if you've lost money on this initial financial instrument, for example, the transaction today was worth $20 million US dollars, but if you had just waited for the natural fluctuation in the exchange rate, you would have only had to pay $19 million. So when we revalued it, you're actually going to have a loss on that in your P&L. However, you're actually going to make an economic gain. Notice that I'm saying economic, not accounting. You're going to have an economic gain in this because now your forward contract is actually going to reimburse you. You've actually made a gain on that difference. It's not going to reimburse you necessarily, it's going to reimburse you in future, but the value of that asset, the fair value, is now reflected inversely by this because it's protecting the opposite way to which the exchange rate is going. So that's what hedge accounting does. It actually allows you to offset that gain against this loss in the P&L or vice versa. Now, you don't have to apply hedge accounting, and of course, if you don't if you don't satisfy the criteria for hedge accounting, you can't apply it. And what will happen then is you'll have the gain or loss for this item, the financial instrument, going through your P&L, and this one will also potentially go through your P&L, but they're not going to offset each other. In other words, you're only going to have the loss of this going through your P&L, and this might go through either OCI or not show up at all. Okay, so let's go through the criteria about a hedging instrument. So, what can an hedged item be? So you must satisfy these criteria, or you can't apply hedge accounting. Obviously, as we discussed before, it's in the benefit of the business to be able to satisfy these definitions and these criteria. So it must be a recognized asset or liability. It must be, it could be an unrecognized firm commitment. It could be a highly probable forecast transaction, or it could be a net investment in a foreign operation, which we're not going to discuss too much in this instance. So in the example of the forward contract over here, they've got a highly probable forecast transaction, and this is what we are trying to hedge against. So in particular, it's the FX exchange rate. So you can look through this and see how this applies to this situation up here. So, hedge accounting, there's three types of hedge accounting, but in this fin module we're only going to be discussing two. So there's a fair value hedge and a cash flow hedge. So a fair value hedge is probably the most common one, and it's basically where the hedge protects the business against the change in the fair value of an asset. For example, we have up here an accounts payable. Now, that accounts payable balance is fluctuating in value up and down. What the hedge is effectively doing is protecting us against downward fluctuations in the value of that payable amount. Therefore, this would be a fair value hedge. Now, cash flow hedge is a different type of hedge, and we'll touch on that a little bit later, and that's to do with the exposure to variability in cash flows. For example, if there's a variable rate, it may impact the quantity of interest payments coming to you, in which case that would fall under a cash flow hedge, where the instrument is actually limiting the business's exposure to variability in cash flow. So that's the two differences between the two hedges. So one is protecting against fair value, one is protecting against cash flows or variability in cash flows. That's the key word. So consistency. So the hedge accounting process. So we need to better satisfy each of these steps, and they're very general steps. I just want to note on a high level that the previous standard that this Ifrs has overtaken is much more broader. So for example, with fair value hedges, which we'll touch on in a second in a bit more detail, previously you had to have a certain level of nominal effectiveness of the hedge, and we'll discuss what that means in a second. Whereas under this current standard, it's much more broad. It doesn't need to be a certain dollar value of effectiveness, as long as you can prove the economic effectiveness and relationship. So if you didn't understand what that meant, that's fine. We'll talk about that in a second. So remember, it's important for businesses to be able to satisfy this because it's beneficial to them. So the hedge accounting process. So first of all, documentation at the inception of the hedging relationship. And this leads into the point one, which is about risk management strategy. So if you cannot document the hedging relationship, you cannot apply the standard. And part of that documentation is about risk management. It's about identifying the risks, the strategy of what you're hedging, and the objectives of what you're hedging. For example, in the previous example, we have a accounts payable amount. We want to restrict our exposure to exchange rate fluctuations in future, therefore increasing our profitability. You need to be able to document this. It also includes, you have to identify whether it's a cash flow hedge or a fair value hedge. So we identified previously that it's a fair value hedge. So eligible hedged items. So we discussed this a little bit more. It must be an eligible hedged items. So we talked about some examples of what they could be before, and there must not be an ineligible hedged item. So for example, a large portion of that relates to credit risk, which is the risk that you may not be repaid. a firm commitment or highly probable forecast transaction. This excludes the FX component of the transaction. Transaction in a company's own equity, and inflation risk. So this is the risk that the payments will be distorted by inflation going forward, or CPI. So, step 3, which we're over here, identifying the hedging instrument. So, we must identify that what instruments we're actually using in this process. So the most common one is derivatives. So, the example we used before about the forward exchange rate contract to protect against FX movements would be a derivative. There's also some other ones, so non-derivative financial assets, non-derivative financial liabilities, but most commonly they'll just fall under this. So this is all very high-level stuff. You don't need to know this in too much detail. This is more for your overall understanding of how hedges work, because if you understand that, you'll be much better placed to answer a question. Step 4 is hedge effectiveness. Okay, so I kind of mentioned this before about what this means. So, in the example where... let me just find where we've got our diagram. In the example where the loss against FX was, for example, $1 million US, the forward contract will generally protect us, or derivatives in general will only protect us against a percentage of that, for example, 70%. So if this exchange rate goes down, your payable is now down $1 million, the forward contract will protect you 70, 80%, 90% of that loss through a fair value revaluation. So this is called effectiveness, and effectiveness relates to how close to that 1-to-1 ratio that you can get. So if you lost $1 million here but gained $1 million here, that would be perfect effectiveness. It would be 1-to-1 effectiveness. So previously I mentioned before that under the old standard you needed to have a certain range of effectiveness to be able to apply hedge accounting. Under this standard you do not. You just have to generally apply that. So we have to identify, is the hedge effective? Are we being reimbursed above a certain percentage? Yes. We move on. No, rebalancing discontinuation. So the other aspect to hedging effectiveness is the quantity or the portion of this entire amount that you are protecting yourself against. For example, your derivative may only be protecting you against 10 million euro of that full 20 million euro payment. So you might still be exposed to the remaining 10 million euro payment and the exchange rates fluctuating around that. So that's when we have the opportunity to rebalance it. So that's when we can actually take out additional derivatives to rebalance that. So we might take out an additional 10 million euro worth of derivatives on that payment. So now we're fully covered. Okay, so that's one option. If it is effective, then yes, we can apply the correct accounting treatment. And then we either apply it as fair value hedge or cash flow hedge. So as I mentioned before, this is purely just the process we must go through to establish whether or not we can use hedge accounting, which is very much preferable for businesses as it offsets much of the loss in the actual financial asset, financial liability, and for the financial instrument that we talked about in part A. Okay, so let's moving on to effective credit risk. So we talked about this before briefly. So there needs to be an economic relationship, and the effective credit risk cannot dominate the value changes in this relationship. So I mentioned before, it must be purely about economics. If the risk of not being repaid on a debt is the main impact on the value change, you can't apply hedge accounting. We talked about hedge ratio, we talked about the effectiveness, we talked about that already. And this is previously the 80 to 125% range was more applicable under the old standard, where you could only apply hedge accounting if it fell within that range. However, in this instance, this is just a guideline so we can prove economic hedge effectiveness. So this is just a guideline. It doesn't need to necessarily complete that rule to be used. It's more about a qualitative assessment and a quantitative assessment in conjunction. So qualitative is about facts, overall non-numerical facts, whereas quantitative is numbers. So that's where checking if the ratio is still in without 80 to 125% range. So it's just an overall assessment of whether the hedge is effective or not. And there's the formula there to calculate that. So it's the cumulative change in fair value of the hedging instrument and the cumulative change in fair value of the hedged item. So the difference between the two is the hedging instrument we talked about before would be the forward contract in that example, and the hedged item is the actual payment itself in euro in 9 months. So what is the change in fair value of those? If that change in the hedging instrument over the actual hedged item is between 80% and 125%, it is effective. We talked about rebalancing and discontinuation already. Okay, so let's talk about fair value hedges. So we can now apply one of these two methods, fair value or cash flow hedge. And generally you should know which one it is by now. Again, just fair value is a hedge protection mechanism against a change in fair value of an asset, and cash flow is protection against the consistency of your cash flows. Okay, so let's talk about fair value hedges. So, we talked about what a fair value hedge is. How do we account for it? So, hedge accounting, as we mentioned before, offsets the gain or loss of the underlying financial instrument. For example, in the instance where we've lost $1 million, the hedging instrument provides us a gain of $1 million as a result, as a protective mechanism, there is no accounting journal. The reason is it offsets that gain or loss in the P&L in aggregate. Now, what this does is we have to post the ineffective portion. So, in the instance where the gain or loss of the derivative is not the full $1 million loss or gain on the financial instrument, that difference is what we have to post as a gain or a loss in the P&L. So, for example, if we had a loss of $1 million in our Forex payment or the financial instrument, we lost $1 million, but our derivative only reimbursed us $800,000. It means the ineffective portion is $200,000. It is the amount that we are not actually. It's a genuine loss, effectively, because you're not getting reimbursed for that. So the journal in that instance would be, for the hedging instrument, is debit hedging instrument $200,000, credit gain or loss on hedging instrument, credit $200,000, and this actually goes through the P&L. Okay, and of course we have to actually calculate the financial instrument as well and the impact of that. But we're just talking about the hedging instrument at this point in time. So that's how we calculate fair value hedges, hedge accounting, and we'll talk about that a little bit more in regards to the journals that we actually have to post. So I'm just bringing them up now. So this resource is available from the website to download. You should already have a copy. So if we just go to journals for fair value hedge. So we talked about hedge effectiveness before. It's the proportion of the financial instrument that is increasing in fair value compared to the fair value of the actual hedged item itself. So previously we mentioned in last year that you could only use hedge accounting if it was within a certain range, but this is just an indicator now. So the journals we actually have to post this is the initial journal that when we acquire the hedged item. It's generally a good idea in your exam to include all journals from year one onwards, starting from when we actually acquire the hedging instrument. However, we've only previously talked about what happens when you have a movement. So let's talk about the movements. So the journals are going to be loss or gain on hedging derivatives. So for example, in the instance we talked about the $200,000 component, we're going to have a $200,000 loss on our hedging derivatives. So that's actually going to go through the P&L. So if we've got a loss, we're going to go debit through an expense. So it's going to go through the P&L as a bad thing. The other side is the FX option, the hedging instrument. So if it's a loss, we're going to go credit. We're actually going to increase that FX option. So measure at fair value at the reporting date. Cool. And we also have to record the DTA DTL. So depending on whether it's a loss or gain, so if it's a loss, we're going to go debit and if it's a gain, we're going to go credit DTL or DTA respectively, and the other side is going to go to income tax expense. And you just repeat this process. So it's quite simple. This journal guide is really going to save you in the exam, especially if you're going to forget that first year journal as well. Okay, so that's really not too difficult. It's difficult in concept, but actually applying the journals isn't too hard, really. Okay, so let's move on to the next section, which is about cash flow hedges. So we talked about before about how cash flow hedges relating to an instrument which protects the consistency and variability or prevents the variability of cash flow. So, how do we do this? So, the effective portion of the hedge can be deferred to cash flow hedge reserve is limited to the lesser of the cumulative gain on the hedging instrument from the inception of the hedge and the cumulative change in fair value of the hedged item. So what does that mean? It's quite similar to how we approach the fair value hedge. So let's have a scroll down, and we're going to move to how to account for a cash flow hedge. So how do we do this? We need to calculate the present value of future cash flows. And there's a table here which will tell you how to do that. The next step is to calculate the changes in the fair value of the hedging instrument. Hopefully the question is going to tell you what this is, so you don't have to recalculate it yourself. Now just follow these tables in the exam, and we'll go through some exam questions later where we're actually going to use this. But for now, we're just going to talk about it on a high level, theoretical, how to approach cash flow hedges. So once you've calculated the change in the fair value of the instrument itself, so for example, we're talking about the change in fair value of a hedging instrument which protects against continual cash flows from a contract which is dependent on interest rate. So how are we going to approach this? So let's consider the example where the variability of our cash flows decline, and as a result we have to post the journal through the OCI. The value of our FX forward, or our derivative, which of our hedging instrument, is going to increase because that also, similar to fair value hedges, changes inversely to the actual loss or gain in the financial instrument. So in this example, we've got a gain, change in fair value of instrument. So we're going to go debit FX forward. And the other side is the cash flow hedge reserve, effective portion, which is going to be the difference. The other side is this one here, so loss or gain on hedging instrument, ineffective portion. So the other side of this is the effective portion here. So we're going to go lesser of cumulative change in fair value of hedged item and cumulative gain and loss on hedging instrument. So let's just go back to our notes and put that into context. So as you can see here, to calculate the cash flow hedging reserve balance, it's the difference between the gain or loss on the hedging instrument and the cumulative change in fair value of the hedged item. So the difference between those two is effectively going to be the ineffective portion. So similar to the fair value hedge, where our hedging amount increased at a disproportional rate to our gain or loss on our financial instrument, the difference, i.e. the amount that we're not being protected by, needs to go through the P&L for the instance of fair value reserve. However, for cash flow hedge reserve, this amount needs to go through OCI. The reason being is that the cash flow amounts are generally reported as fair value through other comprehensive income. Therefore, it's not actually hitting the P&L to begin with. Okay, so that's cash flow hedge reserve. And we're going to talk about the journals a little bit here as well. So we're going to post the change in fair value of the FX forward. We're going to change the change in value, or the lesser of the cumulative change in the hedged item, and the cumulative gain or loss on the hedging instrument. And the difference is that the ineffective portion, which is going to go through OCI. So it's either going to be a loss or gain depending on the difference between the two. Okay, and you just effectively repeat that. Alright, so let's move on to the last section of financial instruments, which is a very complicated chapter, and it's around credit losses. How do we account for that? How do we impair for that? So, during the GFC, one of the major contributors to the GFC itself was the fact that losses on these financial instruments, etc., were not impaired until a much later date. So this did not occur until a year or so in the future, and as a result, individual investors weren't aware of the impact of credit losses on P&L. Okay, so because of that, this new standard was introduced, which means that companies need to impair for credit losses almost immediately, or very, very quickly within the same year. So how do we do this? So there's three approaches, right? There's the general approach, there's a simplified approach, there's the purchased or originated credit impaired approach, and then there's a low credit risk operational simplification. So what does this all mean? It's very complicated. Let's start off with the basics about what a credit loss is and what we need to take into account as to... So for example, the most common example is where we've got debtors, trade debtors. We've got money owing to us. We need to include an allowance for bad debts. So basically, these are debtors which we expect are not going to pay us. Similarly, with a bank might have a loan, and they also need to impair a certain percentage of loans based on historical data of what they expect they might not be repaid. So the new standard says that we must take in a few different things into account. We must take into account the period over to which the expected credit losses might occur. So it's not just limited to 12 months or even just the life of the contract. We need to consider extension periods. For example, rental agreements and other lease options. Leases also often have many extension options, so we might need to extend that beyond the original loan agreement. We need to take into account unbiased probability-weighted outcomes. So during the GFC, it was expected by many of the banks that it was very unlikely that in terms of probability, that many of their derivatives and financial assets for sale couldn't be worthless, which is eventually the correct outcome of what happened. As a result, their probability-weighted calculations were very biased, and their losses were severely underrepresented in their early years compared to what the actual losses were. We need to consider the time value of money as well. We need to consider whether expected cash flows are discounted using the effective interest rate at initial recognition, or whether we're using the variable interest rate. There needs to be reasonable and supportable information as well. So these are just very general. And the other aspect is collateral. So in the GFC, very similar. Many of the financial assets that the banks were selling had collateral impacts upon other assets. So we need to consider the potential losses of collateral losses as well. So it's just some very broad guidelines there. So let's talk about these specific approaches, starting from general approach. So general approach is, so let's skip to some examples. I find like this is the best way. So for example, with cash at bank, the most appropriate method for cash at bank is to look at it within 12 months. So this is an asset held at amortized cost, since cash flows are solely principal and interest. So we're going through that same financial instrument diagram we went through before. Accordingly, the impairment provisions of Ifrs 9 apply. The reason is our primary bank has a very low risk of default, and that we wouldn't have any expectation that they wouldn't be able to meet any withdrawals we made. Therefore, there's a very low credit risk, and given our confidence, we can assume that we can use the 12-month ECL. So what is the 12-month ECL? So we can use the 12-month effective life. We can use the lifetime of expected credit losses. But given there's a very low risk on this item, we can apply the 12-month credit loss. So that means we can look at impairment just over 12 months. given our confidence in the bank, we could assume this to be 0. So again, it's around weighted probability. There's very limited risk around this, so it would be fair to say that we wouldn't need to impair any loss on cash at bank. Let's look at trade receivables now. So this is the simplified approach. So trade receivables, they're also held at amortized cost. If you follow that financial instrument diagram, you would end up accounting for this at amortized cost. So we can apply a simplified approach for this, implying impairment provision. So this means we're not actually required to track credit risk of trade debtor, and we can recognize lifetime ECL. So we don't need to look at 1 year, we look at the whole lifetime of the estimated credit losses. So since our trade receivables are all due within 90 days, we can use our historical data to estimate what we expect our credit losses to be for that one. So that one is the simplified approach for impairment. So the last one that we're going to talk about is the purchased or originated credit impaired approach. So this is where there's actual significant impairment that may have a detrimental impact on future cash flows. For example, if you're a bank and someone has had a breach of contract, or the borrower of the money has had difficulty repaying the loan. In this case, it's appropriate to not apply a simplified historical data approach, and it's not appropriate to use a 12-month view of credit losses. We need to look at the whole life of the loan. We need to consider the circumstances around the evidence of significant credit impairment. So in this case, you might need to write off the majority of the loan for that particular balance. So just to recap, for something like cash at bank, we can take a very simple general approach, which is this general approach to impairment. So we can view that there's very limited risk, therefore there's no impairment. The other option is, for example, for trade debtors, is the simplified approach. So it requires tracking of changes in the lifetime of estimated credit losses. So for example, trade debtors, the most we're going to have is generally 90 days, so we can look at the entire 90 days and look back at our historical data and apply those historical ratios. For example, we might expect that 3% of debtors over a certain number of days cannot repay. Therefore, we'd recognize a credit loss on our trade receivable balance based on this amount. And the last one is purchases or originated credit impaired approach. So there's something with extraordinary circumstances which suggest credit impairment, in which case we might need to apply a very large impairment on that. So it's a very general approach. Generally, in theory, it's not too difficult, especially when you're applying the journals. So if you have a look at the journals here, it's a very simple journal. It's either, once we calculate what the impairment loss is going to be, it's purely just credit asset and debit impairment loss. That's if it's held at amortized cost, for example, trade debtors. If it's held through fair value through other comprehensive income, the way we would do that is debit impairment loss through the P&L and credit the fair value through other comprehensive income reserve. They've also got this example here where the credit loss doesn't occur, but there's still a change in fair value, in which case you'd use these journals down here. But generally, we're only impairing where there is a credit loss, so we'd use this journal up here. So, again, very simple, and you've got this guideline here. Depending on what kind of circumstance might come up in exam, you should feel comfortable be able to approach either just by following this template. Okay, so that's the end of hedging instruments. It's a very difficult chapter. Part A and Part B is probably the most difficult part of the Fin module, so if you can understand this, then great, you should be covered for the exam. If not, that's okay. Maybe just watch the video again or ask me a question. We'll also go through some exam questions later on this topic in the exam preparation series. So if you're still not sure about that, maybe skip to that section. If not, we'll move on to our next chapter, which is Impairment of Assets, which is a fair bit easier than financial instruments. So I'll see you in the next video.